Welcome to TechTO Quick Takes. I'm your host, Alex Reilly, and here are today's headlines. AI startups continue to prove their value. VC funds show a response to the new market, and we dive deeper into the recent Sun Life acquisition news. And back to break it all down, it's Alex Norman. Hi, Alex.
Hey Alex, how you doing?
I'm good. It's been a while.
Yeah, it's been a busy summer.
Definitely a busy summer. So nice to take a little break and enjoy some time off, but good to be back. And it's nice we have a few big headlines to talk about. Just to segue and get right into that, because I know you have a lot you want to go over today. So AI startups continuing to prove their value and also showing why they're doing well. Investors are very excited about them as well, and they continue to raise. And we're still talking about them. So a bit of a combination special again for this. There's a few companies lumped in.
I love seeing different pieces of news and trying to combine them into one trend. And there's sort of one or two trends in these companies. So late July, two Ottawa companies, and in early August, a Toronto-based startup announced large raises. They combined to raise over 200 million. In particular, you had Ottawa-based Solink raise 60 million USD from Goldman Sachs Asset Management, Omers Ventures, Scale Up Ventures, and BDC. Ottawa-based MindBridge raised 60 million from PSG Equity, a private equity firm. And unlike Solink round, which appears to be predominantly primary, 75% of this round is for secondaries to buy out current investors. And then finally, a Toronto-based TechTO raise 100 million USD from Hyundai Motor Group, Samsung Catalyst Fund, Fidelity Ventures, and many others.
So two-parter question to follow up to this. I'm more familiar with MindBridge. I know we've discussed them before as part of TechTO, but what do each of these companies do for those who aren't familiar? And then, of course, the big question is just why were they able to raise and why now?
So I'm going to bundle the two Ottawa-based companies together. So they've been AI-enabled since the start. They're both several years old. Like I'm talking like 5, 6, 7 years old. And they've proven that they can build scalable companies by delivering value. They've got traction and the customers love them. So Solink is estimated to have about 30 million plus in USD revenue. So decent size. What they do is they provide video surveillance software for 18,000 retail locations worldwide. And what they do is they provide value by using AI-based insights from videos recorded from existing security cameras. So they basically upload all the individual security cameras, and the AI identifies stuff like theft, trends. So it provides additional insight from video already taking. So 30 million, if you look at the quotes and the articles about, the customers seem to love them. MindBridge uses AI to help detect fraud and accounting issues. It has about 20 million in revenue and has a global deal with KPMG International, who's sort of offering them as part of their product suite to their customers. So two companies that scaled up a bit, have customers that rave about them, have good numbers. So this is putting fuel in the fire and showing that AI enabled these companies to exist and add value. On the other hand, TechTO's funding comes from expectations about the future of AI and the predicted demand for AI-enabling chips. What TechTO does is design software and processes for AI chips used to do machine learning tasks.
And I know you had kind of lumped the two Ottawa-based companies together, but for this next question, if you could just speak to each one. So what do each of these rounds tell us about each of these companies?
So if you look at the investors and the terms of the rounds, each of these are a bit different. Solink is a classic investment in a growth stage SaaS startup with product market fit. Investors are providing fuel to feed the fire. This is something we typically talk about, very common for lots of these large rounds. MindBridge investment is more of a private equity play. They are cashing out some investors, so some investors are taking money off the table, and they're providing some capital for growth. So, this speaks of a combination that when private equity guys come in, the difference between putting more just fuel on the fire, they're looking for some efficiency. So they'll probably looking at how can we run this company more capital efficient, and they'll probably look at what can we do as a tuck-in from inorganic growth. So not just let's go all in on organic growth, but let's look at acquisitions. So similar numbers, similar adding value, but the investors come with a different mindset. Finally, TechTO despite its huge raise, is more of an investment in the potential. And investors are strategic. The lead investors are strategic ones, hoping to shape the direction of the company and lock up future supply of AI chips. Hyundai Motor invested out of 2 of its car-making units, plans on working with the company to develop CPUs and AI co-processors for future mobility vehicles and robots. So you can see this investment is helping shape the product future of Tense Torrent, and it's off how AI can add value to industries that it's, how it can scale up the value it adds to like automotive.
Right. And I think it's good to highlight also what the investment or that raise might go towards and how it's going to be utilized for growth, I should say, overall. And so just lastly, what is the takeaway and what's relevant within this piece for our community?
Well, AI may feel like it's being overhyped over the last 9 months. Everyone's talking about ChatGPT. It's going to take all these jobs. And it feels like we just went through another phase of this cryptocurrencies blockchain, which was super hyped up.
Yeah.
So that makes people skeptical. Okay, this is way blown out of proportion. But unlike blockchain and crypto, AI has been around for a long time. There's been decades of cycles about AI hype and AI disillusion. And so it's already in a position where it's a bit more mature technology and it's already creating real value. It's creating economic value. Second thing, the companies that use AI to create new or significantly improved solutions will be leaders in the next tech stage, right? So you have, like you look every 10, 15 years, there's a new set of tech behemoths, and the ones that are truly AI native, leveraging this new technology, I think there's going to be 2 or 3 emerging that are like up there with the Googles and the Apples of the world. And finally, for those founders looking to start a company or invest in a company or employees looking at joining a company, there are 3 important questions to consider, and they're all hard. How can AI significantly provide a better solution to a problem for customers? Is this improvement likely to last? So is a real competitive advantage being built? And can the company deliver on its promises? Okay, there might be a potential to deliver a better solution. If they can, it's better, but do you have the team to do this?
Right.
So if I'm looking to take advantage of this early stage of the new AI cycle and get a company that, get on a rising tide, you have to answer those 3 questions. Now, those questions aren't easy to answer. If you can answer them well, you stand to benefit, but you have to consider them.
So just to kind of move along to the next headline. So VC funds are responding to the new funding environment. So again, interested to hear your take on this, but just overall, let's start with just what the news is there, because I know we're doing a little bit of a package deal again with this.
Again, a 3 for 1. I promise everyone the last section will be only one piece of news. So, we have 3 different venture fund announcements in the last about couple weeks. Omer's Ventures announced this week that it was shutting down its London office, that one of its European partners are leaving the firm as it refocuses efforts on North America. Brookfield Asset Management and Sequoia Heritage. And so for those that don't know, Sequoia Heritage is sort of like the private wealth management arm of Sequoia. Announced they are investing $250 million each for $500 million to seed up a new fund called Pine Grove Capital Partners to invest in secondaries and special situations, offering offerings from venture funds and growth funds and their LPs. They hope this gets to $2 billion. And then Next Gen VC Partners announced an $8 million fund that invests in early stage companies near profitability with a focus on Western Canada.
What I've been really interested in hearing more about, especially right now, is just how the market is changing, just the VC perspective and I guess the mindset around how they're adapting. So just in relation to that, how did these funds reflect the new reality, how the market is today, and I guess what does it mean for the ecosystem as a whole?
So just like the 3 fundings we discussed before, were all different and had different implications. I think each of these reflect a different reality. So Omer's retreat from Europe is a reflection of the fact that the European funding market is down significantly from its highs. I think I've read 60 to 70%. Looks like it will take longer to recover. And the fact that Omer's was a recent entrant to the market who had limited brand awareness. So what they're doing is, it makes sense for Omer's to refocus on its core market in North America. And I think the impact here will be that it will be positive for the Canadian ecosystem. Omer's wants to reinforce its brand and its awareness. They're going to be less distracted by Europe, and they have a very strong team here. So I think you can see them to be even more ambitious in their basically home backyard.
Nice. Yeah.
Pine Grove Capital is to me the most interesting fund. It is seeded by two massive financial institutions and exists to take advantage of the current market situation. If you go back to 2008, 2009, you've seen a couple other funds like this created that have created big names that are not necessarily household names, but active players in the venture market. And so what they're actually doing is, if you need to understand a bit of why this opportunity exists. And venture funds, when they invest, they have a limited lifespan to exist. So technically, they're supposed to basically invest and get back all close up the fund and return all the capital to investors within 10 years, and can keep on extending it for a year or two, maybe get to extend it a few times, get to 14 years, but eventually you have to close these funds down, sell the assets, get cash back. LPs, why lots of institutional LPs? You're talking about charities, universities, hospitals invest in venture, and they can't invest in new funds. They need to meet their obligations and rely on liquidity from their funds on an ongoing basis. So in this current market, where you're seeing companies not get bought and not go public, you have venture funds that need to basically eventually sell their assets. So this fund like Pine Grove comes in and offers a solution to VC funds and LPs, and they can go look at the positions and offers to take them off the hand for a significant discount for providing liquidity. And so this works well for all the parties. How does it impact Canada? It's not clear to me. It depends on if they buy Canadian portfolios, and if they buy individual names, what price they pay, and if it's from LPs or funds, and then what are returns. If it's from LPs, the money probably gets recycled to a certain extent into Canadian funds, which then comes back to Canadian startups. If it's from Canadian funds, it depends. Do the Canadian funds actually make enough returns to justify another fund?
Yeah.
They're investing in a situation that did not exist 18 months ago. Early stage companies that are focused on getting to profitability instead of growing at all cost. 18 months ago, if you raised money from venture in an early stage, your goal was to grow. You weren't worried about cash flow positive. Now, if you talk to a bunch of companies that sort of have this valuation overhangs, or their sector is not interesting anymore for venture, lots of them are trying to get to profitability. And usually because they made that change, they have to change their mindsets. It takes time to change your cost structure. It takes time to get growth. There's lots of companies, you go ask them, they say it'll be profitable in the next 12 months. So what Next Gen VC is looking to do is provide, let's call it bridge financing, saying, hey, you need 12 months to get to break even. You have 6 months runway. We'll provide you another 12 months. And they're trying to do it on a relatively affordable basis and get doubles and triples. They're not swinging for a venture scale outcome. This investing doesn't take $1 billion exit. And it's just very interesting to see this. It's a family office that's now sort of fund and raise money from peers to take advantage of the market, because this really didn't exist 18 months ago. I don't know how long-term this opportunity is either.
Okay. You have just a question before we move on. So with OMERS now focusing their attention more on North America and obviously wanting to, I guess, lessen their efforts in other places, I guess just off the top of your head, may or may not be hard for you to answer, but in your perspective, would you see other funds maybe making a move similar to this and just wanting to focus their efforts entirely on North America? Or do you see there being a fair split?
Look, I think, first of all, there's not a lot of venture firms with offices in multiple jurisdictions. You've already seen a move away from American firms from the Chinese operations just because of ongoing political and economic situation and headwinds. So you have, for example, I think it was Sequoia that had a China and an India office and just basically broke into 3 different offices in companies right now. So you usually, when there's headwinds, you see retrenchment. And it may not be geographic. It may be also just stage. Maybe there's a funds that are like, hey, we have a seed fund, a late stage fund, and an opportunity fund. They may have less funds. Or maybe we do life sciences, crypto, and ICT, and they stop. So I think what you'll see is firms either proactively simplify what they're doing to focus on their core, just because they realize they didn't have a passion, doesn't make sense to be distracted when there's headwinds. Or some firms may not have the returns across the board and just focus on where they can get raised capital. So some won't do anything. Some will make a strategic change proactively, and some will have a change forced upon them.
Awesome. Okay. I think this is just an interesting way to think about it. And it was definitely something on my mind after reading these headlines. So just before we wrap up, there's one last story we want to get into, which was the Sun Life acquisition news. So they acquired Dialogue. So hoping you can just get into high level, just what the news is for anyone that might have missed that one.
So in late July, it was announced that Sun Life Financial would acquire the majority of Dialogue Health. That was not owned by Sun Life Assurance Company of Canada, and certain common shares owned by members of the Dialogue management team. Sun Life is paying $5.15 cash per share, which values the entire company at $365 million, but costing Sun Life $277 million.
And just an obvious question there is, why is it only, I mean, we say only 277 million is still a lot, but why is it only costing them that?
Reilly, you did offer to spot me 250 million earlier today, so I appreciate it. Sun Life actual expenditures less due to two factors, which is the majority. So what they already own, so Sun Life, a related entity, already invested in Dialogue and owns a portion, so they're not buying that they're not doing an intercompany transfer and buying from a company. And then in the announcement, it was announced Dialogue will continue to operate independently after acquisition and be a unit of Sun Life. And so it looks like certain management members will be retaining their shares to, I guess, have upside. And so Sun Life doesn't have to pay for those. So basically,
right,
277 million represents the amount Sun Life's buying. The rest is either owned by Sun Life already or is going to remain with the management team.
Got it. So obviously previously negotiated, and that number makes sense. So just, I guess, an obvious one, how does a deal like this come together? How did this one come together?
Yeah, so not sure exactly how this came together, but why it came together. Dialogue hired outside bankers to do a strategic review of the company options. So I guess there's pressure. Hey, the company was down quite a bit. I think it was down like 80% from its IPO price. And Sun Life made the highest proposal to acquire Dialogue, which the company accepted. So basically, they looked at strategic options. I guess part of those options were looking, saying, is there any buyers? They had a bit of an auction, and Sun Life won the auction.
And I understand that the process for deals like this is probably different or unique to, I guess, whatever the specific deal is. But in this case, why did they opt to do a strategic review?
Again, like they were down 80% since their IPO, despite the business. So look, they went public, and two things happened. They continue to perform well with the underlying financials, but the market headwinds and valuation compression pushed the stock down by 80%.
Yeah.
So the board likely felt they needed to protect shareholders, initiate a strategic review with outside consultants and bankers. The acquisition by Sun Life emerged as a promising option to offer return to investors to lock in some cash back. The acquisition price still remains below the IPO price, but it was up 40% from the lows. So, hey, we don't know how long it's going to take to get up to this side. This acquisition is going to return investors. So that seems good. And then when you look at comparables, the revenue multiples of similar deals in last year. So TELUS acquired LifeWorks in 2022. The multiple of revenue was like, I think when I looked at it was like 2.4, and this was 6 times. So it seemed like a fairly valued company given the situation. So if I'm a board of directors, I go, we're down from the IPO, but this just got us a 40% increase. This seems relatively fairly valued compared to the market. So let's take it.
Right. And maybe just to dive into that a little bit more. So again, did see a decline 80% since IPO, and you said it has recovered slightly by 40%. But if I'm Sun Life, why do I make this acquisition? And I guess overall, what was going to be the benefit for them doing this?
So I feel like Sun Life felt they needed to make this acquisition. They had a long-term strategic partnership and relationship with Dialogue. So let's go to this relationship. Sun Life invested through one of its entities $32.7 million in 2020 in Dialogue, so it already owned a big chunk of Dialogue. Dialogue services were offered in Canada by Sun Life via a white label name. So Sun Life offers Lumino Health Virtual Care since March 2020, and that's basically Dialogue. And in July, Sun Life rolled it out to the U.S. Customers, Dialogue again. So you have a company that's invested, so they own a bit of Dialogue. They have a white label solution they offer their customers in Canada, the US. So it seems very strategic partnership. And they look around, and the virtual healthcare sector has been widely adopted since COVID.
Yep.
But it's consolidating. So if Sun Life doesn't make the best offer, maybe someone else acquires Dialogue. It might be a competitor. It might be a situation where a competitor buys it, they consolidate, there's no one else to buy, and now Dialogue, Sun Life either gets, worst case scenario, can't offer Dialogue and doesn't have a virtual healthcare and has to build it from scratch, or even even if it still has it, they're now paying money to a competing life insurance to get a service that they're offering, which is never a situation someone wants to be in. So the acquisition could have the upside of accelerating Sun Life's innovation and revenue growth. One drawback for Sun Life is Dialogue does provide services to other insurers, and maybe they do a review and say we don't feel comfortable paying Sun Life profiting from this relationship with Dialogue.
Right. Okay. And before I ask you what your final takeaways are, I mean, some common themes you're mentioning is obviously this acquisition is for competitive edge and to keep them competitive in this market, and also prior investments that were made within Dialogue. Is there any other, I guess, themes or takeaways that our community should know about from this news?
So, first of all, Dialogue, I think it's been a successful journey. It was worth more at one point, but still created $350 million of value. And I think there's some significant lessons we can learn from these challenges it faced. First, thriving in fast-growing but fragmented markets like virtual healthcare is challenging without unique positioning or distribution. So what I mean here is they've scaled up, they've done well, but it's a heavily fragmented market with a lot of me-too competitors. And I think one of the challenges they had was, what's unique about a positioning? What can we do that no one else can do? And how can we, and without that, you can't grow faster in the market or have a unique, higher gross margins. So that's one thing. Like, think about the competitive landscape. Second of all, overvaluation can be hurtful, for private markets, but especially in public markets. The IPO price reflected the metrics and the valuations for comparable companies at that time. The markets have changed and the multiples have compressed. So despite performing incredibly well, Dialogue saw their valuation crater in the public markets, and it probably forced this acquisition, because in the private markets, if they were well funded, which Dialogue still was, the investors would have had more of a long-term view and could have been patient. So again, this is just my perspective. Do not take this as financial advice. And then, favorable outcomes often occur when a company is bought rather than sold. I think Sun Life's decision to buy Dialogue is a prime example of what this means. Right. I don't know what the next best price was offered, but Sun Life offered the highest price. The reason they did this was they were very familiar with Dialogue. They were a customer, and this was a decision to purchase company instead of looking at a potential sell and saying this is something we want to add. So this is a purchase from familiarity and from strategic perspective. So to always, when you want to sell, you want to have someone that has a reason to buy you. And I think the relationship here, the strategic relationship and past was key to this valuation.
Right. And it would make sense that a company that's getting acquired would want the company acquiring them to have an understanding of who they are. So the fact that there's previous investments in Dialogue makes sense, that they understand the business model and how it's going to, I guess, join forces with Sun Life to create the competitive advantage. So I think that's a great way to close things off before we end the episode. We do have quite a few events coming up, just to quickly highlight. So our next one is Monday, August 14th. An amazing lineup of speakers. We have Nabil from Forma AI, Tina, the Chief Operating Officer at Vena Solutions, and then Ross Rich, CEO and founder of Accord. They've been profiled in the newsletter leading up to it. Obviously, links for those tickets are on our website. Anyone in particular you're excited to hear from on the 14th, Alex?
Interested to hear from Nabil. We've had a Founder's Journey podcast. I found him very insightful in his background. Interesting.
Yes, he had a very interesting, I think, path to becoming an entrepreneur and launched many successful businesses aside from Forma. So it'll be interesting to get to know him more and see him in real life. We also have an event on September 11th and a retail event on October 2nd. So exciting that retail's back again by popular demand. As I mentioned, tickets available on our website, TechTO.org. Also available on social media. We've been posting a lot to promote what's happening. A pretty jam-packed way to, I guess, close out summer and kick off the fall. Alex, as always, thank you for joining and helping us break down all the top stories from the last few weeks. If you liked today's episode, don't forget to like and subscribe wherever you're watching or listening. And we'll be back in 2 weeks' time with another episode of TechTO Quick Takes. And until then, we'll see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea.
So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.